So can you talk about some of the opportunities that you're favoring right now in your core mandates?
In my core mandates, oh, absolutely. There's so many of them. I can give examples. In the high yield debt fund, we have a lot of investments that have 2 to 3 times asset value protection that pay a high coupon. So I'll give you an example. There's a company we recently lent money to over the last couple of months. It's actually a Canadian company. It's called Largo Resources. And it's not a household name, but it's a company with $1 billion equity market cap. What that means is the stock market value of Largo is about $1 billion in terms of what the company is worth. But on top of that, they have around $200 million in debt, and that's where we are, where the $200 million in debt pays a 9% coupon. So there's this much equity value, and there's this much debt, and we're making a 9% coupon on the debt. The reason we like Largo is they're a producer of vanadium.
Okay.
And vanadium, they're a low-cost producer, and vanadium is integral to the steel-making process. It makes steel stronger. It is a commodity, but what we like about Largo and vanadium is that the supply of vanadium is actually coming down because of, it's a long story, but because of pollution controls in China, there's a lot less vanadium that's coming out of certain production processes. So with the demand kind of increasing at a regular rate and supply coming down, that's good for the vanadium price. And this is a company that produces a lot of free cash flow. We're the first lien debt. There's no debt ahead of us. And there's a lot of value in the company behind us. So we feel pretty good about making our 9% coupon in Largo. Another example, I guess, in the high yield funds would be we're a lender to a private company in Canada, and out east you would have heard of it, called Mattamy Homes.
Right.
And Mattamy, being a private company, does not make their financials public. But what I can tell you about Mattamy is that in the bonds right now, we're making a yield between 6.5% to 7%, which is it's pretty good yield given the margin of safety. And the margin of safety in Mattamy is, if you look at everything they own, whether it's work in process or land, the things that you need to be a large home builder, the value of all those things together is roughly 2 times the debt. But if you look at when Mattamy invested in a lot of the assets on their balance sheet, they invested in the mid-2000s. So we think that at market value today, the margin of safety is 3 times the debt. In terms of the asset value at Mattamy is roughly 3 times what the debt is. And we're making 6.5% to 7%, so we think that there's a pretty good margin of safety. And we have an investment that we like a lot in our preferred share fund, and the name is, it's a household name in Canada, which is Brookfield.
Right.
But if you know Brookfield, you know that there's many different corporate entities that issue preferred shares within Brookfield. And the one that we like the most is Brookfield Asset Management, which we like to call the mothership, because there's Brookfield Asset Management, and they own stakes in all the other entities. And the beauty of Brookfield Asset Management is that all the other subsidiaries of Brookfield pay fees up to Brookfield Asset Management. The preferred shares provide an internal rate of return that's in the low 5% area, but that IRR goes up as interest rates go up, and because it's preferred equity, it's actually it has a tax advantage. So to a retail investor, or to us as a fund investor, if we compare the yield on these Brookfields to a straight bond, the yield is actually in the mid 6% area after the tax advantage. And to make mid 6% on Brookfield, where there's very little debt, there's very little preferred, there's a ton of equity value, we think there's a really, really high margin of safety in Brookfield.
It's interest rate protected, and
it's
tax
yeah,
efficient.
The preferred dividend goes up as interest rates go up, and you get a tax advantage because it's a preferred equity dividend.